Okay, we've started recording. This is March 9th, and it's the Market Structure Edge demo and discussion. I mean, it's not really a demo anymore because many of you are pretty good users. If you're new, I certainly try to hit some important concepts for using the platform successfully. I've got my usual points to cover. I will ask you, on point number 5 is what the heck's happening with the market? And we could talk about it right away. He said, isn't supply and demand indicating that the market's going to go up? Well, how come it's going down? So if you want to talk about that first, we certainly can. I can move 5 to 1, and then we'll hit these. Okay, you want me to do that, Kelvin? Okay. Well, right off, I will remind you of one of the core principles of market structure and using edge. There are 3 basic principles. Understand broad sentiment. What's the market doing? Because the market's really driven by these large currents that are BlackRock, Vanguard, State Street, the way that large institutional money. I know. Yeah, exactly. I know. That's number 1. Number 2 is the one that's happening here. Context. And you say, well, there's nothing on the calendar. Options expire next week. It's neither the beginning of the month nor the end. So what the heck's the context? Well, now these data points, like we talked about that if the central bank, Jay Powell, is speaking, that can change the way that money hedges itself. And that's what it is. It's not that that the rational people like, whoa, all of a sudden they change their minds. I mean, do we not know what the Fed is going to do? If you're reading the news and following financial markets, you're pretty aware of the data that they're using. Andrew, I'm going to get to that because I'll show you something. I want to show you a visual that really explains why prices do what they do. And it's not rational people that do it. It is a function of market structure, and it's over 50% of the trading volume. Remember, over 50% of trading volume is driven by machines that simply follow models. They sift data and they look for things just like we do. I've described this before. I did this SEC panel yesterday, and the number 2 guy at Virtu was on that. There's Doug Sifu, the CEO, and then there's Steve Cavoli, who's the global head of execution and the CEO of the broker-dealer. And their models look for stocks that are 5s that are becoming 6s, and they buy those, and 5s that are becoming 4s, and they short those. And at the end of the day, they like to be 0, have no exposure. So I'll show you an image, but when there is a change, it can be magnified by those things, and that can happen. There's no question that's occurring right now. It doesn't mean that at any given point, based on the supply and demand in the market and the fact that passive money is the principal force, I think over the 30 days, you conclude that passive money you can look across your dashboard and see that, has been a net seller, and that will weigh on markets. But in the short term, unless supply and demand break down, we're going to have a big update. Maybe it's tomorrow with jobs data. It's a risk. It could be. We might be up 700 points tomorrow. I'm not saying we're going to be. So don't say that I said the market's going to be up 700 points. But I look at the supply and demand, and it keeps me calm in these situations because prices are not predictive. But I absolutely believe that those are the things that are playing out. And I'll show you, Andrew, in response to your chat comment. Let me share my desktop, what I'm talking about. So, I have been giving presentations on market structure for 18 years, something like that. This is not the right one. Here it is. Okay, so this is what I wanted to show you. It's a slide put together by the stock exchange called IEX. So see this right here. And they're very, very good friends of ours. They're the people who are in the Michael Lewis book called Flash Boys. Brad Katsuyama, Ronan Ryan. I traded notes with Ronan just a couple of days ago. Not bragging. They're just people in the market structure circles. It's a small community, and we all know each other. So this is the answer, Andrew. So it's showing when the stock market is a market maker model. That means every trade is handled by a registered broker dealer. It's the law. So when you hit a button, your broker dealer, of course, is whoever your broker is. Schwab, Ameritrade, E-Trade, Morgan Stanley, Robinhood, Interactive Brokers, whoever it is. And so there are effectively three kinds. There is a full service broker dealer who provides all the support, including capital. Morgan Stanley is an example of a full service broker dealer. There are agency broker dealers who only execute trades. They don't commit money. They commit the trades and the customer provides the money. So Themis Trading, where Joe Saluzzi, one of the panelists, comes from. Instanet, which is owned by Nomura now, that's an agency brokerage platform, and then you've got proprietary trading firms like Citadel, Virtu, Hudson River Trading, Jane Street, Quant Lab, Infinium, GTS, Tower Research. I could go on and on. They just trade their own capital, and what IEX did was look at how prices change when the principal behavior in the market is each of the three. And you look at full service broker dealers, and this is in a very short period of time. How do prices change? Well, not much. There's a little bit of change. There's a little bit more with agency broker dealers because they can't stabilize. You know, a full service broker dealer could in fact, T. Rowe Price looked at this. Put in hundreds of millions of trades, some to buy and some to sell, to execute 1 million shares. And so it can stabilize the market. Then you got proprietary traders who are able to react to the direction much faster. Best technology, the best infrastructure, the fastest machines in the market, the Ferraris. And look at the dramatic difference in the way that those prices behave. The thing is, remember, these folks don't own anything at the end of the day. At least that's the aim. And so that can dramatically change the direction of the market. But it is not rational behavior. It is machines sifting the data and go, uh-oh, whatever was there is gone. Whoa, tip the market over. Or conversely, money's coming into the market, run it up. The machines can do that. They're very fast, and they're trying to capture just tenths or hundredths of pennies, and that can really change the market. It's why I always say, don't trade price. Price is capricious. Technical charts depend on prices, but remember, for those to work correctly and well and consistently, all prices have to be treated as equal. They're not. And here's the proof. All prices are not equal. The time horizon of the people whose orders are being handled plays a huge role. Full service broker dealers are going to be handling orders with an investment horizon of certainly longer than a day in nearly all cases. Same with agency brokers. So they're less concerned with the direction of the price in the short run. But these guys have a very short horizon and they can change price. That's what we call fast trading on the platform. So that has a dramatic effect, but it doesn't mean that any change has really occurred in the market other than prices. So that's why you revert to supply and demand. You say, well, I'm down 3%. Should I panic and sell? Well, I would encourage you not to. I mean, you want to certainly be, I'm not saying that we don't want to take chances, but I think that's a very important thing to know. Let's let Tim into this affair. So, questions, comments, anything about that I can clarify for you? It's just an important thing to know. Hands, questions, anything? Okay. This whole notion of prices not being predictive is very important. I'll give you an example today. Look, I'm still in EQT and RRC. I should have sold them 2 days ago before Powell talked, when I was up, about 1% in them, less than I would like to be. It could be, but again, is that rational? I mean, would I don't disagree with that comment. I mean, we have the first 200,000 jobless claims number that we've had since December. So it could be, no question. But again, is it rational behavior, or is it, stuff like 0 days to expiration, where there's no underlying asset change? Nothing has changed. No ownership change has occurred, and prices change. Well, then that the probability, if supply and demand are on your side, it will move in your favor. I'll give you an example. Before I do, because I want to show you something, I also want to talk about this exception. In the market desk note today, I said, is there, you generally, when we're long, we want to buy rising demand and falling supply, particularly over 5. I prefer very at or near 10. Are there exceptions to that? I'll give you one here as an example. Let me just, Steve, oh good, Steve made it. Okay. I'll give you an example of when there might be an exception. The reason we don't isolate this on edge is because the probabilities are not nearly as good as the ones we do provide in volatility or low volatility and momentum. But here's Tesla back in December. So an example would be, in fact, I'll take 2 cases in point, or points in time as cases in point. So if Tesla was a 1 and supply all of a sudden deteriorated, could you make money? Well, probably, but it's not as consistently true as when Tesla is a 10 and supply declines. But you can see that here. So if you were watching it and it's a 1 and then supply fell right into options expirations, could you make money? Well, there's added risk right into options expirations, but clearly the price rose. Then you can come over here at the end of December and it's a 1, it's a 1, it's a 1, and supply falls. Could you buy that? Well, again, it's year end, there's risk there, but you know what happened with the price. And but otherwise, just realize that if you're looking for those, and look, we've done years of research into this. If it was consistently true, we would put it on the platform. I try to put what I try to do and what our team tries to do is give you the very best probabilities. So that's an exception to demand over 5 and diverging supply. That's what we always want to trade, but it's worth noting. Now, let me give you this example. So Enphase today, so I bought and sold it today, and I bought it yesterday, sold it today. So here's what I mean. Does this, I mean, it's not great, right? So the fact that this is returned to 50, it really shortens my time horizon. But strong demand, and then the price was down, it's volatility. If you're new, I'll show you what I mean. That means, let's just go look for the portfolio. We know it's in the momentum or it was. Now we'll have to find where it's in. Is it in energy or is it in tech? I think it's in tech, yeah. Okay, so let's go look at the volatility. But the fact that it was down, I bought it down 3% yesterday. So, which is most of its volatility. And it's just a way to know mainly what to expect. It's not always true. It's just a good central tendency that it will be a good read, about 4%. So I think it was 3.7 yesterday. So if the stock's down 4% and it has a strong supply demand divergence, what is the probability in the next 1 to 4 days that it will rise above the price at which I bought it? That's the only time price counts. Right? I mean, price counts when we buy and when we sell. But in terms of predicting what will come, of what predictive usefulness is price? None. I mean, all the time, well, when it gets to 17 times earnings, as I said in the market desk note, well, buy it. Well, that'd be true if 80% of the parties who were buying and selling the stock were motivated by that. But the truth is, about 9% are motivated by that. So over 90% are not. They're motivated by how price changes, allocating resources to a model. So I've got to have a certain percentage of this, or trading derivatives. Those are much bigger forces than whether something's trading at a proper multiple or not. That will be true about 1 out of 10 trades. Not a great read. That's why I don't think earnings multiples are a very good indicator of what the market will do. Supply and demand are the best indicators. So then as soon, because the stock doesn't have a great demands or supplies at 50%. If I get a 2% gain, I've got a 5% gain. So I took that today. And that is, I'm just using it as an example of what to do. There are also, what do you do if you're in EQT and RRC, as I am? You could look at EQT and have I You know, have I made a mistake with it? Well, I mean, it's not great, right? What's the best time to sell? Soon as demand or supply deteriorates. Look, the price could continue to rise, but that's a great reason to leave. So my wife said, well, you should sell that before J. Powell speaking. I was up nicely in it. And that was probably true. But now what do I do? The probability remains because the demand is still strong and the supply is still falling. There is a probability. I now incur greater risk. If I stay today or tomorrow, look, it's riskier. There's no question. But I also know that there is a strong probability, all other things being equal, that it won't just have day after day after day of down if it has that supply demand equation. And the same is true with the broad market. If I look at the broad market, this is not great demand. Demand has only returned to the green line, which is the entry point. So will it stall here? I don't know. But I look at the probability coming off of a steep relative drop in supply in the broad market. What historically has happened? Well, it's been volatile, but there's a very high probability that we get another little bounce. I mean, we had this very strong move right here. Now it's deteriorated. What's the chance that in the next number of days there's a strong update? Well, it's pretty good mathematically, probably enough for me to stay. If we were here and supply was rising, I would be more concerned. You'd say, well, but the market went up. Oh, it's very volatile and supply went back down. The mathematical probability when demand is rising and supply is falling that you get a return is very high. The mathematical probability is not non-existent that you can get gains when supply is rising and demand is falling. But all other things being equal, that's what I will take. So I don't get worried if it's down because there's a good probability. And we all take losses at some point. I've had a very good stretch, very good. It's almost too good, right? When it's like day after day, things go well, and I'm taking these nice gains. It's when you get a little cocky, right? I should get a little greedy. I should have taken that 1% and been happy with it. So that's how I look at it. And you want to kick that around? You have examples you want to share? Steve, welcome. Nice to see you. How's Mexico?
Muy bien.
Good. Good. Author of the Hicks rule. That's what the Hicks rule is when something's at 10 and supply falls, that's a very high probability for returns. There are other pieces of that puzzle, but we tested that. Steve was the one who said, I ought to take a look at that. And we modeled it and we said, son of a gun, that's pretty good, actually. And we added it to the platform for that reason. So anyway, can you look at SQ? Yes, I can. Okay. M and F. So let's talk about both of those. And let me see if I have missed anybody. Okay, good. I have not. All right. Yeah, because SQ is I look, to me it was the best of the lot. Look, it's not at 10. That's a weaker condition than when it's at 10 and supply falls. But I look at this big supply deficit here, and the price is down and demand's rising. Look, it could stall there, but these conditions to me offer a very high probability of a return, and I presume you would agree.
Take a look at it.
What's it doing?
Down 4.
So that's the other thing to look at. The risk here is there's a very material data point tomorrow, the monthly jobs data, and we have no idea that jobs data has a standard deviation of 37%. They change it so much that you just don't know. So you could have a huge, strong jobs report as we did last month, and they could revise it, and who knows what this will be. But if you look at block, it's called now, in a portfolio, and you look at the volatility, it's down its full volatility. The risk that we take is that tomorrow the jobs data dramatically affects what the market does, one direction or the other. The reward opportunity is strong demand, falling supply, down its full volatility. The probability is extremely good, diminished by the jobs data tomorrow, of getting a return of at least half that. At least half that. That's how I look at each of these. Yes.
AR is there too.
There you go. AR is down 3%, and again, is Antero Resources a little harder to trade, as you've probably seen. I didn't mention it as much because it's already, it's peaked, and maybe even you could say begun to lose some demand, but the supply side is very weak. So the probability is that there is a good day in there, even if it then continues down. And I don't know. But yeah, this is not as good as hitting the ceiling, but pretty good probability. It will depend on whether the supply-demand equation in the broad market delivers what it could tomorrow. We'll see. And then Macy's. Let's look at Macy's and realize this is a different time period because it's bigger. I mean, really, it's just the display feature that led us to do that more than a particular statistical reason than you see if you look up here at the 30-day view with the quick search. But let's go look at Macy's. Macy's 48% short, 4.5% volatility. Really big price moves, and again, I don't pay particular attention to that. This is not as good. This was the principal reason for me. If I rank them, I would say, well, I'd really like to see a steep drop in this. If this had dropped boom like that, I would say, wow, there's a really strong probability that produces a return. It is the weakest of the three to me. That's how I would think about them. And it's not all these are central tendencies. You don't have to be absolute about them, but it's pretty apparent when you have a good supply demand imbalance that's developed. How is volatility calculated? It's a 5-day average. It takes a rolling 5-day read. And why 5 days versus 3 or 2 or 1 day or 10 or 20? I mean, we measure all of that. 5, 20, 50, 200 day. We track all that stuff internally. But that is the read that is the best reflection of the patterns that we see in the market. And it's not that those things, look, we try to keep this simple. I have spent a lot of years talking to CEOs and CFOs of public companies and providing data to them and trying to keep it simple because we can track all kinds of things. And the more we add to it, the more they wander off into the weeds and forget the central point. And it's why we don't put everything that we could on this platform. There are a lot of data points that we have. I can say, well, that's really interesting. That's really interesting. But is it directly applicable to making good decisions about trading? No. My point about that is the patterns move in about 5 days. It's actually one of the ways we find activists because the patterns deviate from, if I've got a position like, okay, the Powell spoke, now our interest rate expectation is this, so we need to adjust our exposure to this, and they hand them off to like Morgan Stanley, JP Morgan, Goldman Sachs, who execute those trades, and son of a gun takes about 5 days because there's no liquidity in the market. You can't just go, here are 5 million shares of this and 5 million shares of that. Doesn't work that way. You can only do that with ETFs, off market in large blocks, which is why they're very popular. But so those patterns play out. So reading volatility over that period of time is very constructive and rooted in good data. Dan, TFC. Well, tough today in financials, right? Here's an issue. It is something I wrote down, and I don't know how you could control that. I think that is one of those things that happened like in March of 2021 and in September of 2022. In March of 2021, there was great supply-demand divergence, and all of a sudden the market just went south, and I thought, what the heck? And then the news broke that Credit Suisse lost $8 billion in the Archegos debacle. Well, what happened today? There are two core things that occurred today that are, to me, potentially canaries in the coal mine. In 2007, there were two Lehman hedge funds exposed to mortgage-backed securities that failed. And everybody went, what happened? What happened there? And off we went. We didn't realize that it was the first signal of huge trouble. Well, today, Credit Suisse said they had to raise, they're trading at $2.50. Remember, JP Morgan bought Bear Stearns for $2 a share. So Credit Suisse, which is one of the major banks in the world, one of the 12 largest bulge bracket prime brokers on the planet, and it's trading at $2.50. And it's down dramatically. And I think that is affecting the group. You look at the regional banks, Silicon Valley Bank said they have to raise capital. I mean, they're down 30%. Those are two canaries in the coal mine. That is what's hurting you. It's the derivative side of the coin. It's not supply and demand. Very high probability that TFC bounces back from that because it's being sucked down by something that has nothing to do with it. But look, what do? You can't predict that those things are going to happen, and that's a risk. There's almost no way you can account for it, So, yes, Andrew, rolling 5 days, and then you keep rolling that. So you're always changing the read, but on a 5-day rolling average, we use that methodology a fair amount. We use it in short volume because that data is very lumpy, and there are other things that we do with it. Okay. Let me get to. I think. Well, this is good. I mean, what else? What else have you got? I've got one more thing to cover because we've kind of jumped around and covered it all, and I'll keep you a shorter time today. I've been a little long-winded the last 2 times. What else have you got? Anything else concerning it?
Trends are on 30 days.
So I'll show you what's 30-day. So in here, when you look at these tiles, that's a 30-day, that's a 30-day. If I look this up, this is also a 30-day read. I'd prefer that be a 5-day. We have an internal discussion about it because it kind of bothers me that you look at the lead behavior is looking over a 30-day period. That maybe we should shorten. But those are all 30-day reads, makes it very easy from a data standpoint. And if I pull this up as a quick search, it's going to give me a 30-day view. That's 30 days. It might be 30 trading days. January 25th to March 8th, 30 trading days. So why those? It's rough. It gives us roughly a month read. Could it be 20? We use 20 a lot internally, but the statistical significance between those things is de minimis. The main thing, I do believe that shorter reads matter in today's market because everybody moves in short increments. I mean, look at the time frames. We've moved from the average holding period for Berkshire Hathaway, Warren Buffett, in his stock positions used to be 27 years. Now look what he did with, what was this position he just sold? He held it for 2 years. Very unusual for him to do that. And in the market, we've gone from, what they called eighths and teenies, 8 to 12 cents, basically, spreads to tenths and hundredths of a penny. And the narrower the spreads, the shorter the time horizons. Everything has been compacted, reduced. And that's why when all these pundits on CNBC are talking about, they're looking months out, it doesn't work very well because all of the machinery of the market, all the risk management tools, everything has compacted and shrunk. And so then we have to be aware of that. We don't have to, be minute by minute, but it's important to understand that. Okay. Last thing I've got, 5 in momentum, 7 in low volatility, that we've stayed right there. And what has the market done? It has not delivered. It has not delivered momentum. It's delivered returns. Today would be the first day to me where it's been very difficult and a difficult market, and things have not performed well. But up to this point, now almost all the way through the first quarter, it's been a very good. If you're disciplined about taking gains, take the gains. Find the next thing. Take your 2%. Find the next thing. Take your 2%. Don't be greedy. Don't look back. That you do that. It's been a very, very good market for us, for me certainly. And look, it takes time. But today, no question, it's a challenge. I would say statistically, I'll repeat it. I would say statistically, looking at this data, that there's a very strong chance of a big up day. Then I don't know, and it may not happen. It's just a statistical probability. You have markets that show rising demand, falling supply, and they don't deliver. Boom! At some point, they do all of a sudden, and we'll see, won't we? Okay. I think that is all I've got. Any wrap up stuff? Tim, thoughts on Etsy as they show? Well, let's take a look at it. And I think it got 2 downgrades. I mean, I think downgrades to me coming from the sell side. Sorry, Steve. Yeah, I mean, it might be. I would prefer. I'll tell you, what would be better is if it were doing this, right? And supply was surging. With demand all the way to 1 and supply 67%. What this tells you is that everybody knew that these downgrades were coming, right? All the customers of the firms already knew and were short. And you say, well, isn't that inside information? No, it's just the relationships on the street. Like you're gonna know. I was an IR guy. I would talk to the analyst covering me. And while I had to be non-material in my color, I would certainly say, well, you got to look at the trends in handsets. I mean, those things are coming down. That's the way I would provide non-material color, right? I'm telling them in their models, they're wrong. Right? So everybody knew this was going to happen to Etsy. So I don't know. It could be the reverse. I mean, if there's any decline on the supply side, you might make some money on it. But either way you cut that, it's a dicey trade to me. It's not the stuff I will take a chance on. I'd rather do something else. Stay away. Stay away. Yeah, yeah. It might be. And it's another little canary in the coal mine to me. Etsy is my sister-in-law is an excellent crafts person who uses Etsy, and she does Christmas decorations and ornaments, and Etsy is her chief engine. But it's an indication of that's discretionary spending. You buy stuff like that because you got extra money. When Etsy begins to show shrinkage, it's telling you, well, the budget to buy crap is going away. So how do you pick a good short? And we'll make that the last thing. Again, and I would refer you to Barry Norton, Barry Norton, the Edge Mob expert on shorting. But here's what these are beta. Again, the only way I short is currently with SH because it's very liquid. So it's just a short S&P 500 fund. But you can buy thousands of shares at the market. Because it's so liquid, because everybody's using it for that purpose. But here's what you look for. You want falling demand and rising supply. Basically, the reverse of momentum is what Barry Norton would say. If this produces gains, this produces declines. But again, I think the principle applies that you're not looking to make 50%. You're looking to make a few percent, and then repeat, wash, rinse, and repeat. So if I look at and there aren't a lot of them in here. That's an interesting thing. Notice what led though, financials, right? Financials were the core component of this. And if I look at here's an example. You want plummeting demand, particularly to me, dropping just below 5, and very high supply. The probability that those things decline, something in this order, is very high. If we look at PFG today, is it down? Probably. I don't know. But there would be a great example of and you say, well, it's below trend. Yeah, but it's 65% short. Very high probability of producing a short side return that way. Okay, well, that was fast and furious, but I hope productive. So now we'll see. Just keep your eyes on the broad sentiment supply demand equation. That to me is very important. There's weakness in momentum. There's weakness in low volatility. Not a lot of choices. So don't take chances. Just take gains. Okay. See you next week. Have a good weekend. Thank you very much, everybody.
Gracias.
De nada.